The DXY is one of the most talked about charts in crypto. Everybody knows about it, talks about it, but often when it behaves differently than expected, there is confusion. Many crypto traders are aware that during bull runs, the DXY normally trends lower. It then trends higher during bear markets, but thinking they are always correlated is a trap that can get you wrecked. It's time to look behind the curtain and see what makes the DXY tick, so as traders we will never be surprised by its price action. To know how to use it, we first need to understand it, so let's break it down. What is the DXY and what causes it to move? Many novice crypto traders believe the relationship between the DXY and risk on assets is similar to the relationship between stablecoins and crypto. The ebb and flows of tether dominance inversely correlate to crypto asset market caps, and often this relationship appears to be the same with the DXY. However, these periods of correlation are more signs of economic and financial conditions than a function of the DXY. Let me explain. The DXY is a measure of value of the US dollar in relation to a fixed basket of foreign currencies, not a measure against risk on assets. If a direct comparison to crypto was to be made, it would be like comparing market caps of different stablecoins, for example Tether against USDC. However, attempting to make this comparison would be flawed, as the US dollar plays a unique role in the global financial system, which no individual stablecoin in crypto does just yet. Let's get into the facts. The DXY, formerly the US dollar index, is known as the USDX, DX, or informally the DXY. The index is maintained and published by the US company Intercontinental Exchange Incorporation. The index is a weighted geometric mean of the dollar's value relative to the following select currencies: the European 57.6, the Japanese yen at 13.6, the pound sterling at 11.9, the Canadian dollar at 9.1, the Swedish krona at 4.2, and the Swiss franc at 3.6. The DXY began in March 1973 after the dismantling of the Bretton Woods system. The basket of currencies has only had one revision when the euro was added in 1999. The fact that so many major global currencies are not included, such as those of China, Mexico, South Korea, and Brazil, of which are all major US trading partners, gives rise to constant questions about the true accuracy of the DXY as the dollar strength indicator in its current form. This may become more relevant in the future as competing nations seek to challenge the status of the dollar as the global reserve currency. So, what moves the DXY? Like any measurable asset, the DXY moves in value based upon supply and demand. For the DXY, this simply means dollars are being bought or dollars are being sold. Dollars can be sold for assets or sold for other fiat currencies. Both will affect the DXY. This supply and demand cycle is more complicated than a simple commodity because the DXY must both be considered against foreign currencies and risk on assets simultaneously when you're looking at the correlation. For example, due to the near 60% weighting, the DXY may also be thought of as an inverse euro index. If there are localized economic woes in the eurozone, money will flow to the dollar. The DXY will gain value, but in this instance, risk on assets will not correlate. Often though, there is an ancillary correlation when the localized economic woes appear, because money also flows from risk on assets into the dollar due to the market uncertainty and fear. You see? Likewise, risk on assets can move without the dollar losing value. This can happen when money flows from both the dollar and from a larger portion of its basket currencies into risk on assets, thus maintaining the value ratio of the dollar against other currencies. Why does the DXY move up in a recession? Another common misconception for people new to economics is that a strong dollar means a strong US economy. For many countries in the world and their local currencies, this may be true, as it demonstrates the confidence in the stability and growth of their economy when their own currency is strong. Although a strong currency is harmful for export-focused economies. However, the dollar is viewed as the world's premier safe haven currency, so the strength of the dollar is viewed by many as a bellwether for the wider global economy, and by the extension of that of the US economy itself. When there's global fear, money moves to safety and the dollar pumps. During recessions, interest rates are normally increased in an attempt to balance the economy, slowing growth and curtailing borrowing. These rate hikes in the dollar encourage hot money to invest money normally kept in offshore accounts and foreign banks, and they flow into the dollar in search of both yield and comparative stability in relation to the smaller global economies and related currencies. The second effect of a recession is a lack of confidence in economic growth, and that means reduced confidence in risk on assets such as stocks, funds, and now also crypto. In normal economic conditions, capital outflows from risk on assets often move into various global currencies. However, during times of economic uncertainty, capital flows from risk on assets predominantly to the safe haven of the dollar. as during these times of global fear, many weaker currencies behave like risk-on assets, leading to the hyperinflation. This double shot of buying pressure is why the dollar index sees its largest moves during times of global recession, economic downturn, and uncertainty. So, with all this being said, how do crypto traders use the DXY? As much as it pains Bitcoin maxis to hear, Bitcoin is currently more correlated than not to risk-on assets on a larger time frame, and thus, so is the rest of crypto. At some point in the future, it's highly likely Bitcoin decouples from being seen as a risk-on asset. It's almost happening now. We are seeing the idea take seed with the current banking crisis, and it will remain to be seen how long this inflow lasts. For crypto traders, the DXY is a very important asset to track, along with markets such as the S&P 500 and the Dow Jones. The DXY is important because it allows traders to follow the flow of capital. When capital is flowing out of the dollar, it is often a sign that risk-on assets are going to pump. It's quite common to read arguments that the DXY cannot be charted because it's not an actual asset, but that's false. I chart it every day. The DXY may be charted just like any other asset, and in fact, the DXY can be traded. For example, the Invesco DB USD Bullish ETF tracks the DXY price, and the Intercontinental Exchange Inc. offers a futures contract on the DXY. If the DXY is moving and the markets are stagnant, this often confuses people. This is because they expect a dump in markets when a DXY pump, and vice versa. Insight can be found by charting various forex pairs. For example, there are large outflows of the euro that is likely to be accounting for the dollar strength. Traditionally, in recessions, once signs of economic reversal start appearing, the DXY will front-run economic recovery by dropping, and risk-on assets will pump before the dollar flows into foreign currencies. Thus, the DXY on larger time frames can give experienced traders a unique insight, and many investors keenly watch the DXY on those time frames for that very reason. I hope you found this informative, and it gave you a larger picture of how a trader like myself tracks the macro movements of markets. Tune in for another Lifer Deep Dive as we keep pumping out the content to keep you informed and entertained.